Canada's housing market holds $8.2 trillion in real estate wealth, but with interest rates at 5% and home prices up 60% since 2020, some markets are dangerously overvalued. Could your $800,000 home be sitting on a ticking time bomb? If Canada slides into recession, which cities will see the fastest crash? Today, we're counting down 10 Canadian housing markets that could collapse hard when the economy turns. Starting with number 10, let's dive into the markets where your biggest investment might be at serious risk. Number 10, Halifax, Nova Scotia. You might think Canada's Ocean City would be insulated from housing chaos, but this Atlantic market is sitting on a powder keg. Between 2020 and 2023, Halifax median home price rocketed from $285,000 to $475,000. That's a jaw-dropping 67% jump in just 3 years. What fueled this frenzy? Out of province, buyers flooded in during the pandemic. At the peak, 35% of all purchases came from Ontario residents and other provinces seeking affordable coastal living. Remote work made it possible, and Halifax's charm made it irresistible. But here's the problem. The local economy couldn't support these sky-high prices. Halifax median household income sits at just $68,000. Yet today, a median-priced home with a 5% mortgage costs over $3,100 per month. That's nearly 55% of gross income before taxes. No wonder locals are getting priced out. The city's job market makes things worse. 28% of Halifax workers depend on government positions in federal offices, universities, and provincial departments. When recession hits, these public sector jobs face the first budget cuts. Add in the fact that many pandemic buyers stretch their finances thin, and you've got a recipe for trouble. Inventory is already climbing. Halifax now has 4.8 months of supply compared to just 1.2 months in 2021. Price cuts are becoming common, and that stream of Ontario buyers has slowed to a trickle. If recession strikes, Halifax could easily see a 20 to 25% correction. But while Halifax grapples with these Atlantic region challenges, the mountain communities of British Columbia face their own unique pressures. Number 9, Kelowna, British Columbia. Picture this: you're sipping wine overlooking Okanagan Lake, thinking you found paradise at a reasonable price. That dream just became a nightmare for anyone trying to buy in today. Kelowna's median home price has absolutely exploded from $450,000 to over $900,000 since the pandemic started. That's more than doubling in less than 4 years. What drove this insanity? Cash buyers flooded in from Vancouver and Alberta. At the market's peak, 42% of all purchases were cash deals from out-of-province buyers seeking their slice of wine country heaven. These weren't locals moving up, they were wealthy investors and retirees with deep pockets bidding against each other. But here's where it gets dangerous. Kelowna's economy runs on tourism and hospitality. 22% of all jobs depend on visitors coming to taste wine, hit the slopes, or enjoy the lake. When recession strikes, discretionary travel spending gets slashed first. Hotels sit empty, restaurants close early, and ski hills see fewer visitors. The market is already showing cracks. Inventory has ballooned to 6.8 months of supply compared to just 1.2 months in 2021. Luxury lakefront properties that once sold in days now sit for months. Local buyers earning Kelowna wages simply cannot compete with $900,000 price tags. If recession hits and tourism collapses, this resort town could see a brutal correction of 25 to 35% or more. The combination of speculative pricing and economic vulnerability makes Kelowna one of BC's riskiest bets. Moving east across the Rockies, the prairie provinces face their own volatile mix of resource dependency and housing speculation. Number 8, Saskatoon, Saskatchewan. Here's a city that shouldn't have a housing crisis, but absolutely does. Saskatoon's population has barely budged in recent years, yet home prices have surged 45% since 2020. When demand stays flat but prices explode, you know something's seriously wrong. The culprit? Speculation mixed with a dangerously unstable economic foundation. Saskatoon's economy depends heavily on potash mining, oil services, and agriculture. These commodity-driven industries swing wildly with global prices. When China's economy slows or crop yields disappoint, Saskatoon feels it immediately. Yet during the pandemic boom, investors ignored these fundamentals completely. 18% of recent home sales went to investors hunting for Canada's last affordable markets. These buyers drove prices up across neighborhoods where local families earning Saskatchewan wages suddenly couldn't compete. A city that once prided itself on reasonable housing costs now sees many residents priced out entirely. Here's the kicker: mortgage stress tests are failing as interest rates climb above 5%. Buyers who qualified at 3% rates 2 years ago now can't handle the payments. Delinquency rates are quietly rising, and inventory is building as sellers realize the party might be over. Saskatoon sits at 4.6 months of housing supply, up from just 1.8 months in 2021. Price cuts are becoming more common, especially in newer subdivisions where builders got caught up in the frenzy. If commodity prices crash during a recession, this prairie city could see corrections of 20 to 30%. The risks intensify as we head into Ontario, where smaller cities have become unlikely hotbeds of speculation and vulnerability. Number 7, Windsor, Ontario. This border city got caught in a perfect storm when Toronto's housing crisis sent buyers fleeing in every direction. Windsor seemed like the obvious escape route, just 4 hours from the GTA with reasonable prices and small-town charm. But that reasonable quickly became ridiculous. Windsor's median home price exploded from $310,000 to $580,000 as desperate Toronto buyers invaded with cash offers and big city budgets. Local families who thought they'd found stability in Canada's automotive capital suddenly couldn't afford their own neighborhoods. The irony? Many of these Toronto refugees were fleeing the exact same affordability crisis they just created in Windsor. Here's where it gets dangerous. 25% of Windsor's jobs depend on the auto industry, and car manufacturing gets hammered first in every recession. When people stop buying vehicles, Windsor stops working. Add in the thousands of residents who commute daily to Detroit, and you've got a workforce vulnerable to both Canadian and American economic shocks, plus currency fluctuations that can slash purchasing power overnight. The market is already cracking. 52% of current listings now show price cuts, and inventory is climbing steadily. Many of those Toronto buyers are having second thoughts about small city life, especially as remote work policies tighten and commutes become reality again. If recession hits both sides of the border simultaneously, Windsor faces a brutal squeeze. Auto layoffs, cross-border job losses, and fleeing investors could trigger corrections of 25% or more. The vulnerability spreads beyond these smaller centers, though, as even Ontario's larger urban markets reveal their own structural weaknesses. Number 6, Hamilton, Ontario. Steel City reinvented itself as Toronto's affordable bedroom community, and the transformation has been stunning. Hamilton's median home price skyrocketed 75% since 2020 as GTA buyers discovered they could get more house for half the price, just one GO train ride away. What seemed like a win-win situation is now looking like a dangerous gamble. The city marketed itself perfectly to Toronto's priced-out middle class. Why pay $2 million for a Toronto townhouse when you could get a Hamilton detached home for $600,000? The pitch worked too well. Neighborhoods that locals called home for generations suddenly filled with Toronto commuters who bid up prices beyond what Hamilton wages could support. But here's the vulnerability. Hamilton's housing boom depends entirely on GO Transit and corporate policies that keep Toronto workers commuting. If remote work becomes permanent or hybrid schedules reduce office days, why pay Hamilton prices to live an hour from downtown? The entire value proposition collapses. 20% of Hamilton's economy still relies on manufacturing and steel production, sectors that get crushed first in recessions. When factories cut shifts and plants close, the local job market can't absorb all those Toronto commuters if they suddenly need work closer to home. Investors jumped in hard too. 24% of recent sales went to speculators banking on continued Toronto spillover demand. But that investor activity is now unwinding as rental yields shrink and price appreciation stalls. Hamilton inventory is rising and bidding wars are becoming rare. If recession triggers both job losses and a shift toward permanent remote work, Hamilton could face a perfect storm. The danger escalates even further when we look at markets where the price increases have been truly astronomical. Number 5, London, Ontario. University towns used to be stable, predictable housing markets where professors, hospital workers, and students coexisted in affordable harmony. Not anymore. London's median home price has exploded 80% since 2020 as investors discovered what they called undervalued southwestern Ontario. The result? A speculation bubble that's completely distorted this college city's fundamentals. Here's where it gets weird. 15% of London's rental properties got converted to Airbnb units as investors chased short-term rental profits from visiting parents and business travelers. This gutted the student housing market and pushed rental prices through the roof, forcing more students to compete with families for regular homes. The entire ecosystem got turned upside down. London's economy runs on steady, modest-paying jobs. Hospital workers, university staff, and local government employees form the backbone of the city. These people earn decent livings, but they can't compete with $650,000 median home prices. Young doctors finishing residency, professors starting careers, and nurses supporting families are all getting priced out of their own community. Builders caught speculation fever too. New construction permits jumped 60% as developers rushed to capitalize on rising prices. But much of this new supply targets investors, not local buyers who actually work in London. The mismatch between what's being built and who can afford it creates dangerous oversupply risks. When recession hits, university towns face unique pressures, enrollment drops, hospital budgets tighten, and those Airbnb investments become millstones around investors' necks. London could see corrections of 25 to 30% as the speculation unwinds. Back in the West, Alberta's energy-driven markets are setting up for their own dramatic reckonings. Number 4, Calgary, Alberta. When oil prices recovered and energy companies started hiring again, Calgary's housing market went absolutely wild. Home prices surged 55% since 2020 as workers flooded back and the boom mentality returned with a vengeance. But this oil-fueled housing frenzy is built on the shakiest foundation imaginable. Calgary's entire economic story revolves around energy prices. When oil hits $100 a barrel, the city feels invincible. When it crashes to 40, mass layoffs follow within months. This boom and bust cycle has defined Calgary for decades, yet buyers acted like this time would be different. They forgot that commodity cycles are ruthless and unpredictable. Here's where it gets dangerous. Builders launched 12,000 new housing units, the biggest construction boom in over a decade. These aren't just filling current demand, they're betting on continued energy sector growth and population influx. But what happens when oil prices correct or recession kills energy demand globally? Interprovincial migration tells a story. During the recent boom, thousands moved to Alberta chasing high-paying energy jobs. In recession, that flow reverses fast. People who bought homes expecting Calgary wages suddenly face unemployment or moves back to their home provinces, leaving empty houses behind. Interest rates above 5% are already stressing buyers who qualified during the low-rate years. Energy sector layoffs could trigger a cascade of forced selling, especially in newer subdivisions where builders created oversupply. Calgary could easily see 30 to 40% corrections in some neighborhoods, just like previous oil busts. Even the stability of government employment can't shield some markets from dangerous overvaluation, as we'll see in the National Capital Region. Number 3, Gatineau, Quebec. Cross the bridge from Ottawa, and you'll find one of Canada's strangest housing bubbles. Gatineau became the affordable alternative for federal workers who couldn't afford Ottawa prices, but that affordability advantage has completely vanished. Home prices exploded 70% as Ontario buyers flooded across provincial lines, creating a market built on commuter dependency and economic confusion. Here's the disconnect that makes Gatineau so risky. 38% of recent buyers were Ontario residents earning Ottawa salaries but buying Quebec homes. They're paying Ontario-level prices for Quebec properties while navigating different tax systems, mortgage rules, and legal frameworks. Many don't fully understand what they've gotten into until closing day. Quebec's local wages simply can't support these inflated prices. While federal workers commute from Gatineau earning $70,000 to $100,000 salaries, local Quebec residents make substantially less. The entire market depends on that cross-border flow of Ontario money, creating artificial demand that Quebec's economy can't sustain on its own. The commuter vulnerability is massive. These bridge-crossing buyers depend entirely on federal workplace policies. If remote work becomes permanent or hybrid schedules reduce office requirements, why live in Quebec and deal with the complexity? The value proposition collapses immediately. Currency fluctuations add another layer of risk. Quebec buyers using Ontario banks face exchange considerations that most don't fully grasp. Tax implications differ dramatically between provinces, catching many off guard at filing time. When recession hits and federal budgets tighten, Gatineau faces a perfect storm of reduced migration, policy changes, and economic reality. Corrections of 25 to 35% are entirely possible as the cross-border speculation unwinds. Yet even these dramatic vulnerabilities pale beside what's happening in Canada's most extreme speculative markets. Number 2, Victoria, British Columbia. Canada's retirement paradise has become a nightmare of unaffordability that's pricing out everyone except the ultra-wealthy. Victoria's median home price has skyrocketed to $950,000, an incredible 85% increase since the pandemic began. This isn't just expensive, it's economically impossible for anyone who actually works on the island. The buyers driving this madness? Retirees with cash. 45% of all purchases are cash deals from wealthy seniors liquidating mainland properties or cashing out investment portfolios. They're chasing ocean views, mild weather, and small city charm, but they're creating a market completely disconnected from local economic reality. Here's the problem. Victoria's economy runs on tourism, government services, and retail jobs that pay nowhere near enough to afford these prices. A nurse at Victoria General makes $60,000 a year. A teacher at the school district earns similar wages. Even doctors and lawyers struggle with million-dollar home prices. The people who keep this city running simply can't afford to live here anymore. Island isolation makes everything worse. Unlike mainland markets, Victoria can't diversify its economy easily. There's no tech boom, no major manufacturing, and limited growth potential. The entire market depends on wealthy outsiders continuing to pay premium prices for island life. When recession hits, those cash-rich retirees will see their stock portfolios and real estate investments crash. Suddenly, Victoria starts looking like an expensive mistake rather than retirement paradise. With 45% of the market vulnerable to investment losses, this island market could face devastating corrections of 30 to 40%. However, one market combines all these warning signs with an even more explosive mix of speculation and vulnerability. Number 1, Barrie, Ontario. This lakeside city 90 minutes north of Toronto represents the most dangerous housing market in all of Canada. Barrie's median home price has exploded 110% to $750,000 as desperate GTA buyers fled north seeking affordability. What they created instead was the mother of all speculation bubbles. During the peak frenzy, 65% of buyers came from the Greater Toronto area, armed with big city money and willing to pay any price for escape. These weren't locals moving up. They were refugees from Toronto's housing crisis who just exported that same crisis to a small city that couldn't handle it. Barrie went from affordable family town to commuter suburb overnight. Here's why Barrie tops our list. It has zero economic foundation to support these prices. The city has no major employers, no tech sector, no manufacturing base. It's entirely service-based retail, restaurants, and local businesses that pay modest wages. Yet somehow it now costs $750,000 to buy a median home here. The commute dependency is lethal. These Toronto buyers face 90-minute drives each way, making their entire investment dependent on corporate policies about office work. If hybrid schedules become permanent or gas prices spike, why live in Barrie? The value proposition evaporates instantly. Barrie represents everything wrong with Canada's housing market: speculation over fundamentals, outside money over local needs, and short-term thinking over economic reality. When recession hits, this perfect storm of over-leveraged buyers, commuter dependency, and speculative pricing could trigger the most dramatic correction in the country. Barrie's crash could easily reach 40 to 50%, making it not just Ontario's riskiest bet, but Canada's most dangerous housing market gamble.